So I'd like to welcome everybody. Thank you so much for joining us for our Topics at 12 webinar. We've been very fortunate to partner with a lot of great people in our region. We have been partnering with the Small Business Center out at Rockingham Community College, our state rep, Susan Reagan, and she's doing a great job sponsoring this series and pulling all these folks together. So very happy to be working with her. This is the fourth in a series, and we're going to continue these. They started as a result of the pandemic, and those of us that have been working together really wanted to be able to bring you guys something that was not only for now, not only for things we saw pre-pandemic, but for the future and moving forward, which that's a lot of what today is about, is the future. So thank you to the Reidsville Chamber, Team Reidsville, the Economic Development Team, and the County Economic Development Team for helping us bring this all together. So without further ado, I would like to introduce to you Andrew Santulli, who is with the Small Business and Technology Development Center, the SBTDC. So we are very excited to have him, and he's going to be speaking about business exit strategies. So Andrew, take it away.
Thank you, Diane. Pleased to be with you here today. We're going to spend probably the next half hour or so going through some details, and then we'll certainly have time for questions. If you want to stop me during the course of it for something specific, just please turn your mic on and we'll hang in there and go forward. All right, Roy, if you can bring up the first slide. The next one. Roy, let's flick to the second slide. Okay. All right. Well, that's our organization, the SBTDC. Some of you are aware of it, the Small Business and Technology Development Center. We're a SBA partner. Half of our funding comes from SBA. The other half comes from the state legislature. There are about 70 to 80 of us in the state of North Carolina. I am out of the Triad area, which includes Greensboro and Winston, and Rockingham County is one of 10 counties that we serve out of our office here in the Triad. So if anyone needs any follow-up after this, we'll certainly be happy to provide that. We provide no-cost counseling services for small businesses in the state of North Carolina. Let's go on to the next slide, Roy. Just to give you a rough background, is I've been in business for over 35, probably 45 years now, and been involved mainly in business and manufacturing. I was in the aerospace industry and the furnishings industry, and for probably the last 15 to 20 years involved with small businesses, starting one of my own back in the early 2000s. I've been with the Small Business and Technology Development Center here for about 10 years now. I actually work for Winston-Salem State University in Winston. Among the businesses I've worked with through this time are a variety of things: health and safety. We've worked with people in human resources in the hospitality and food industry, and manufacturing. One of the things I spend most of my time on now are helping people either buy or sell businesses. They're basically two sides of the same coin. So we'll now go into really, thinking about what would cause you to think about selling a business. Now, given the fact that selling a business is a distinct operation, one thing you want to think about is, I've got clients in their 40s and 50s that we've had this conversation with. When you buy a business, it's not a bad idea to have an exit strategy. That doesn't mean you have to execute it immediately, but it's a good idea to have an exit strategy because it helps you build and direct the business. And often when you're in a business, in order to sell it, you have to spend a considerable amount of time preparing it for sale. And I'll explain that in detail here in a little bit. But there are a number of things that cause people to think about specifically an exit strategy. One of them is retiring, and that could happen anywhere from in your 50s, and some people are waiting till their 70s. I've got a client who's an attorney who I started working with in his early 40s, and he told me he wanted to retire by the time he was 50 from day-to-day operations. He just wanted to sit back and look at some of the businesses he has. So he wanted to have an understanding on how he would develop them, what type of businesses he should acquire, and then how he prepared himself to retire. He's 47 now. I've been working with him for almost 5 years, and he's well on the way to retire. Since we first started, he's acquired three more businesses. So he owns like 6 of them right now. So it's a good idea to have an idea of where you're going. It's the old adage, if you don't know where you're going, you never know when you arrive. So the other thing that would cause a triggering event for thinking about exit strategy is a change in lifestyle. Often people do things because their life has just changed from the norm. That could be the death of a spouse, a business partner, some type of illness or aging on the part of the owner. Divorce often causes the sale of a business because there's a settlement. They have to come up with cash, and that ends up causing people to sell a business. A new spouse, getting married, maybe you want to do something different. A child, you may decide that, running my own business is not working well. I want to change things. The other thing is just the entrepreneurial spirit. Some people just don't like doing the same thing for an extended period of time. That's not uncommon. People may run a business for 5 or 10 years and say, I've been through all the aspects of this business. It's not fun anymore. I want to do something else. That's part of the aspects of this particular individual I spoke about earlier. He said, I don't want to keep doing this for the next 30 years, so I need to have other challenges. So he's buying more businesses, and then he wants to turn around and package them, try and sell them off and live off the income from selling them. The other things that cause people to think about exiting a business, is a downturn in business. With the COVID right now, there are some people who may exit business, because their revenue's not keeping up or they can't keep the business going. Well, the likelihood of selling the business is probably not great, so we're probably going to come into another method of getting out of the business, which might be orderly liquidation. Or, when there's a downturn in the business cycle, they may want to look and do something else that might be give them a better return. Another thing it may be is that the product or service that you're offering is no longer viable in the market that you're working. So that may cause a change or the need for a sale. The sale might easily go to someone else who's a competitor of yours in a situation like that. Let's switch, Roy. Now, when you're thinking about selling a business, there are a number of things you have to think about at that point in time. The first one does not normally happen in most circumstances. Most businesses at the time of a owner wants to sell are not ready to sell as is. They may be, or that may be the only solution for an individual. If someone has a medical reason or a problem and they can no longer run the business, they may be forced to sell it as is. When selling a business, one thing you want to look at is the value of the business in terms of how this would be perceived by the people you're trying to sell it to. In most circumstances, if you're trying to sell a business whose gross revenue is less than $1 million, you're not really selling a business, you're selling a job. A business that generates revenue, in most cases, there are exceptions to everything, but under $1 million generally is not large enough for an owner to be independent of the business, namely hire a manager to manage it and run it on a day-to-day basis. So if it's in that realm, you're basically selling it to someone who's going to operate it full time, and they are basically buying themselves a job. And, like I said, that number varies a bit. Many of the businesses I deal with are below $1 million. So we're working with someone who's trying to pass this business on to someone else and sell it to someone else who is going to operate it as an owner-operator. The next thing you want to look at when you're thinking about a business, and this kind of falls back into the background that we work with on the SBT to see it most of the time, is we help people build their businesses. Many businesses need to be grown or enhanced before they can sell it, because there has to be value in order to sell it. I've come into many circumstances where the exit strategy for a business owner turns out, instead of being months, is years. Now, in a normal circumstance, to sell a business, you're probably talking about 12 to 18 months, unless you're going to have a fire sale, or once again, there's always exceptions. but generally the selling cycle is at least 12 to 18 months. Assuming the business is on its face in a good condition, you have a number of things in place which make it manageable by another person to whom you would sell it. But many businesses we come across have a number of intrinsic faults or problems that make it difficult for someone else to buy it and give you any value on it. So I've had many people that I've worked with for 5 years or longer so that we could grow the business into an organization or into a structure that would make it saleable, in which case they could get a good return on their investment. Many cases, we've tripled the value of the business in 3 to 5 years, and that's not an uncommon circumstance. However, the individual has to be prepared and willing to take the time and often have the cash available to cause this business to be transformed into something that would be enhanced for sale. The final point here, looking at as an option for people, as I mentioned earlier, is liquidation. You know, if you're in a situation where a partner passed away, or if a spouse inherits a business and the owner operator passed away, and they have no ability to operate or run the business, and they don't have any readily available buyers, often they're put into a situation of orderly liquidation. And that means sell off the assets and accept what you can get for the value of it. In this case, you may have a customer list that you could sell off to another competitor or a supplier. You may have a building that can be sold as real estate. You may have machinery and equipment that can be sold off. But that's basically an orderly liquidation. Okay, a non-orderly liquidation would be in a situation where you didn't have the opportunity to take the time to move through these steps one at a time, and you basically just had to generate cash quickly, and in that case, you're into a fire sale. Okay, the next item we're talking about is what is our planning process, okay, for an exit strategy. The first thing, and this is something that a business advisor, and this is something we do often in the SBTDC, is identify the areas of business that need improvement. There's a number of things you really need in place in order to be able to sell a business and have confidence that you're going to attract a buyer. One of them is that you have a good distribution of customers and suppliers, and this will come up a little bit further down the road, but if any one customer represents more than 20% of your revenue, okay, that is an unstable business, because under any circumstances, you could easily lose a customer. There may be a disagreement between your business and the business that you sell more than 20% of your volume to. There could be a change in technology. That business could be taken over and the new owners have a relationship with someone else. So one area you want to look at as you're planning the business is to identify those areas and where one customer represents more than 20% of your business, and you want to work on changing that. Now, that doesn't mean you give up business with those. It means you look for business in other areas. And this is in both in products and services. I had this same conversation with my son, who's an attorney. For a while, he had 3 customers that represented 70% of his business. That was a problem. It took almost 2 years to change that by recruiting new business. That's true in many circumstances. The other area maybe is a supplier. If one supplier represents the majority of where your product comes from, you could be held hostage by that supplier. So you want to make sure that your business is viable. I had that exact circumstance come up with not one supplier, but one country. I've got a client right now who sells clothing, okay, that comes from Southeast Asia. And almost all of it came from China. And when the tariff went on in China, he almost put his business under because his costs went up by 25%. He scrambled to try and diversify. He's still in that process right now. So these are things that you don't typically think of at the beginning, but if you're thinking about an exit strategy, and that's why it's not a bad idea to think about these things, okay, when you're operating a business on a day-by-day basis, would my business be acceptable to someone that wants to buy it? By the way, it would be more acceptable to me as an operator if I did. So the motivation and the timing for the seller is very important, and it's important for you as a counselor or as an individual, okay, to be able to think through this process when you're working with someone, okay, what is my plan and where am I going? Do you want to leave immediately, okay, and do you want to not be involved in the business? Well, anything's possible. If your business on the surface is worth $1 and you want to leave tomorrow, you might get 30 cents for it. If you're willing to stick around for a while, get the right buyer, and then help that buyer transition, you may get $1.50 for it. So there's a large range, okay? Price is the last thing you look at when you're trying to work your way through an exit strategy, because price is really determined by terms and conditions, okay? And you really have to look at things. The next area, you're looking to get the highest price. Well, like I said, if you're willing to stick around for a couple of years, work with the new buyer, help them through the transition, you may get a lot more money for it. If you want to sell it tomorrow, then the amount of money is going to be a lot less. The other thing maybe is, how do you want to be paid? Okay, often small businesses require owner financing in order to be able to move forward. In many circumstances, banks are very leery in financing small businesses and the sale or transfer of a business. There are circumstances where they do, but often that's not the case. So in order to be able to transfer and sell the business, the owner often has to provide owner financing. In many of the circumstances I've worked with people in owner financing, the typical model I use is they get some money up front so that there's skin in the game from the buyer. Now that's money that you get, which is non-returnable. And then often we'll structure a loan that has a balloon payment after 3 or 5 years. The owner is paid on a monthly basis, okay, by the buyer. If for any reason the buyer defaults during that period of time before they pay the balloon payment, the business goes back to the original owner. Now, that may seem like a good deal or a bad deal depending upon where you are. It's not usually the best thing in the world, so you want to make sure you've got some cash on the table up front, at least 10 to 20% of the value of the total business transfer, because someone could mess a business up pretty bad in a year or two to the point where you can't get the value out of it. Often it does help on both sides if the seller is involved, and it's a lot easier to get somebody to buy a business if the seller is willing to finance it, because that tells the buyer that this business does have value. If I'm not selling you a pig in a poke, over time you're going to see that this business will go forward with the proper management, and the seller often has to be involved in the business, not on it necessarily on a day-to-day basis, but has to be there to answer questions, maybe help with a transaction with a customer, help resolve some problems with suppliers or staff. So, you know, looking at how the transfer occurs in terms of financing has a lot to do with it. It's part of what you have to determine you're willing to do up front. The next thing is, which ties to that, is the after sale involvement. Are you willing to be available a day a week, a day a month, you know, on call? That all affects how much you can get for the business. The next thing is, you know, what are the expectations of your customers? Do they want to see you around for a while, your staff, your suppliers? If you're involved in the transition, often things will go much better. The next quote, I take that from somebody I've worked with in the, which we call M&E business. Timing directly affects price, okay? Do you need to sell the business today, or can you sell it sometime in the next 3 months or in the next 3 years? Timing directly affects price. Okay, you have to know what your situation is and when you have to sell, okay? And then you want to think as an individual, what am I going to do after I sell this business? Some people have trouble with retirement and stopping. Other people can't wait for it to happen, but this should be part of your thought process. Okay, let's switch here. Right, okay. The next thing that's important once you get into this and you've made a decision you want to do it is confidentiality. It's important on both sides, the buyers, the sellers, your customers, your suppliers. Confidentiality is an important issue. The one thing you want to do, okay, is, well, first of all, if you want to sell a business, this is not getting into confidentiality. This is getting into marketing. You have to tell people you want to sell it. Okay. I often have people who say, well, I don't want anybody to know that I'm selling the business, because if I do, then I'm going to lose my customers. My customers are going to go somewhere else. That's a pretty limited view of it. Okay. If you can explain why you're selling, and most people can, often you just have to look at them. You know, there are a lot of people who put off selling a business 10 years ago because the market wasn't good, and many of them are in my age group. We're in our 70s or heading towards our 80s. You know, we've been doing this for 30, 40 years. So now we're looking for a reasonable transition. And if you don't tell people you're selling it, you're not going to find any buyers. But what you do want to do is you may tell people, yes, I'm looking to sell this business. But before you get into any details, you want to have an NDA, which is a non-disclosure agreement. And what that says is, I will not, the individual that I'm going to sell this to may not want to be known in the marketplace as being a buyer, in which case you have what's known as an MNDA, a mutual non-disclosure. And that buyer may be a competitor, and he doesn't want other competitors to know that he's thinking about buying it. Or it may be a customer, and he doesn't want other customers to know, he or she, that they're buying this business. So the confidentiality really helps with your potential buyers. And also, before you give any detailed information, okay, about the business, other than general order of magnitude for sales, yes, we sell more than $1 worth. No, you know, we don't sell over $10 million worth. You give orders of magnitude. To get into details, you want an NDA, a non-disclosure, between you and the potential buyer so you can share some more details. I mean, this is like getting into dating. Okay, you first meet, you have a nice conversation, but as you get further, you want to have some type of agreement as you're going to go further into things. The next thing you want to do, which many people overlook, is to help keep the confidentiality, you want to have a secure email account and phone number that can be used during the sale process. This is particularly true. I've got many clients who have, you know, just sales at the ABC company, so that any emails that come into them are visible to everyone in the company. Now, if you have 1 or 2 employees and they know that you're selling it, that may not be an issue. But if you have a business of any size, you may not want all your employees to know about the details of what's going on. So for the small amount of money that it costs, go out and set up a separate email account for this transaction. Okay. And also have a separate phone number. You know, if people are going to call you, do you want them calling the business phone number? Do you want them calling your cell phone? Maybe you do, but at least think about this and don't just assume that, well, I'll get the information when I need it. Okay. The next thing is, don't share detailed information until you get that signed NDA. Okay. Another thing you want to look at, which comes a little bit further in the process, is a LOA, or a letter of intent. And that's basically a statement from a proposed buyer that says, I'm interested in buying your business. It's non-binding, okay, on either part. It's a letter of intent. You don't need an attorney at this point for these first couple of documents. A letter of intent says, you know, I'd like to buy your business, and I'm willing, you're asking $1 for it. I'm willing to give you 85 cents for it, okay? And I'm willing to put 20% up, and I want you to hold the paper for the balance for 5 years. And I want to do this in the next 90 days. So a letter of intent is a general indication of what a buyer is interested in. And if a buyer is working with a business broker or is working with someone like ourselves who help people buy businesses, they understand this, and they're willing and they're interested in providing you with documentation about this. One thing you want to do is you want to work with educated buyers. You know, don't think that, wow, this is going to work out better if I get somebody who doesn't know what they're doing. That's not a good way to go into a business transaction. You want the person with whom you're dealing to be as knowledgeable about this process as you are. because then it's going to work better for everybody concerned. The other thing is you're going to get into what's known as a due diligence period. Once you've had a letter of intent and somebody's interested in looking at the business, be prepared to answer hard questions. Somebody's going to look at your finances and say, you know what? You lost 20% 4 years ago. Why? Or for the last 3 years, your sales have been going down, or your sales have plateaued and they haven't gone up, or it looks like you only have 4 customers for your entire business. Why is that? Be prepared to answer hard questions, all right? Or looking at this business, you haven't taken any money out in the 5 years, and that's how you're operating it, and it's barely breaking even. You know, why isn't the business doing any better? You have to be ready to answer these questions, okay? Because if you're not ready to go into this process. Talking about confidentiality, I think I've been through this. It's important to everyone, your customers, your suppliers, your creditors, your bank, okay? You know, employees might get anxious and say, wow, you know, this business is being sold. I better look for a job somewhere else because my job may be eliminated, okay? The other thing is the buyers themselves may not want someone else to know about this. Okay, Roy, let's go to the next one. Okay, when you're thinking about selling a business, you need some trusted advisors to be working with, all right? Your basic core is the owner has to be involved in the process. This is not something you delegate to someone. If you do, it's probably not going to work out very well. I'm not saying you can't, but you shouldn't. So the seller or the owner has to be involved in it. The other thing is you want a good accountant, and you probably want a tax accountant, all right? Now, your current accountant may be fine with closing the books and doing bookkeeping and taking care of QuickBooks, but if they haven't dealt with the sale of a business and a business transaction, they're probably not aware of the tax implications. And it's important to know that, because as you've heard many times on lots of, you know, announcements, et cetera, it's not how much money you make, it's how much you keep. And that's true in a business transaction in a big way. I had one client who was selling their business that they ran for 20 years. When we first looked at it on the surface, it looks like their tax liability was going to be about 20% of the value of the transaction. We sat down and worked with a tax accountant who's not cheap. You know, initially when we first looked at it, she wanted $400 an hour. We had 3 hours with her, okay? And they saved over $200,000, okay? Because of looking at and being aware of opportunities that their accountant had no idea existed. And by the way, their accountant sat in during the transaction and during this consultation and learned a lot about it. Another thing is an attorney. The first couple of documents we spoke about, the letter of intent, which would come from a buyer, the non-disclosure or the mutual non-disclosure, those are documents, you know, that you can handle on your own. We have them available, etc. Once you're really getting into the documents about buying and selling a business, the cost of an attorney is a very small investment. So I suggest to all sellers, they plan on putting some money aside for both an accountant and an attorney if they want the transaction to work properly. The other options is you may want to ask an advisor, such as, you know, ourselves, which is what we do from the Small Business and Technology Development Center, Small Business Center counselors. They work with and help people in evaluating their businesses and looking at transfers and how this process works. The next one might be a business appraiser. Do you want an appraisal for the business? If you do, you know, that's something you would have to purchase through an appraisal. Or if you're not comfortable with, or you can't find a viable buyer, you may want to use a business broker, okay? So a business broker typically will have a minimum fee, just to know that, between $25,000 and $50,000 and or 10% of the value of the business, which is ever higher. You know, that's a typical business broker's cost of doing business. Okay, the next one, if we can, Roy. Potential buyers. Who would I look to if I want to sell my business? Usually the first default one is a family member, and often that ends up in a succession plan. Do I have children? Do I have nieces and nephews? Do I have other family members who would want this business? You still want some help in talking about this transition. You may want some help in valuation, okay? But you want to think about that. That's usually the first place. The other thing would be an existing partner. And one issue I would make is if you're going into business, this is switching hats and go on the buying side, you want to make sure that you have a written agreement whenever you go into a partnership, such as a detailed dissolution agreement. If one partner dies and the other partner ends up inheriting the other partner's half or the partner who passes away, their spouse or family members inherit the business, what's the situation for the remaining partner? Do they have the first right of refusal to buy the business? Okay, or can that family member keep it? Often a family member comes in, owns half of a business, but doesn't have the skills to participate in it. The person who's left from the partnership is now caught with a lame duck partner, and now they have trouble keeping the business afloat. That's just the beginning of the telltale in here. So there should be a rather detailed written agreement, which is part of a dissolution agreement that exists if you go into a partnership. It helps when you're selling it. Also, as I go back to the other side of the business where we help people buy businesses, you want to think about that. You know, a bad partnership arrangement is worse than the worst divorce settlement you could ever think of. In the last year or so, I've helped at least 2 people get out of that, and it was a nightmare. Okay, the other thing may be current management, okay, or other employees within the company. ESOPs come up in here. That's rather specialized in detail. I won't go into it at this point. ESOPs generally only work for larger businesses that are, I would say, in the 3 million and up. Okay, it's rather expensive, or there's a fixed cost and a monthly cost in order to keep ESOPs functional. So that's something better said in another conversation. The next thing is competitors. Competitors are probably one of the better places, and probably a significant number of businesses go to competitors. Okay, they're in the best position. They want your customer list. They may want your capacity. Okay, they may want some of your technology. So they're a great place to look for selling a business. The other thing are suppliers or customers. They may want to vertically integrate. You may have a supplier, okay, who would like to be able to sell the end product that you make using their raw materials. And you may buy from 2 or 3 suppliers, and this one supplier may say, well, I can get more business if I can keep their business afloat and I supply all the raw materials. Or you may have a customer who particularly likes your product, okay, is in a position to vertically integrate and decide, well, maybe I'll take this business over. Now I'm guaranteed this supply chain, okay, and I can generate some more revenue by selling to my competitors. So don't be afraid of competitors and suppliers. They're the best place to look. The next thing is an individual investor. Sometimes there's an individual who may want to buy and operate your business. Now, investors are the ones who are going to look for a business that are going to be greater than $1 million. Because if they're an investor, by their nature, they're not going to come in and want to run and make widgets all day long. Okay, they want to be able to come in and hire professionals to operate it so they can make money from it. The next thing may be private or a public equity firm. Once again, in the same position. Your business has got to be large enough so they can put capital into it so it can continue to grow, okay, using management in order to operate it and still be able to make money, okay? And in other areas, if you're having difficulty finding something, you may go to a business broker, you know, and be willing to pay their fee because they can come up with a client when you have not been successful in this area. Okay, let's go to the next one if we can, Roy. Okay, valuation. This comes up in many circumstances, okay, in all circumstances. What is my business worth? You may think it's worth $1. The marketplace may think it's worth 30 cents. And under the right circumstance, you may be able to sell it for $1.25. I do not value businesses, okay? We do not, okay? If you want a business valuation, you have to go to someone who values them. We can work with you, and I can work with you in giving you an estimate of value to give you a range. I might look at your business, look at your assets, your customer list, etc. You may say, and I don't want to know what you think it's worth up front, and I may look at it and say, you know what? I think this business could go anywhere from 70 cents to $1.15. You may think it's worth $1.50. That's fine. But it's probably somewhere in from that 70 to $1.15. I'm probably pretty safe that that's the right area under most circumstances. There are exceptions to everything, but I'm not going to give you a number. First of all, do I know how to value? Yes. Am I going to go in there and tell you it's worth something, and then later on you don't sell it for that? You come back and tell me, well, you gave me the wrong number, or you gave me a number too low and I got more for it. That's not the business I'm in, okay? With the position we have with the SBTDC, provide this service for you at no charge. And we want to help you be able to transition from your business. We're not here to get into a discussion on, well, you didn't give me the right number, etc. We'll give you a reasonable range. Most businesses that sell for under $1 million usually don't get appraisers. Appraisal's not cheap. If you want to get them, I would encourage you to do so. So often we'll give you a range, and if you sit down and look at it and you understand the way we explained it to you, most people can resolve to themselves that, yeah, that's probably true, okay? Often we have to tell people their baby is ugly. Your business isn't worth very much, okay? If you want to be able to sell it and get more for it, these are the things you have to do. And we're free to make that decision and tell them that, because we're working in a realm of saying this is the range and we're here to help you. Okay. Some of the methods of valuation are looking at things of, multiples of free cash flow, or what's known as SDE, or seller's discretionary earnings. How much money does the owner receive from operating this business? That's not just salary. It includes everything and anything else in the business that accrues to the owner. There may be paid life insurance in the business that goes to the owner. There may be a vehicle that the owner has for their own use and operations. There may be expense accounts in there that if the owner leaves, that goes away. If the owner owns the real estate, okay, and is paying the real estate company that he owns rent on the business, that's income in there. So seller's discretionary earnings starts at net income, and then it's usually an addition to it. And that gives you a measure of the value. How much value would come out of this business if I bought it? Okay, and then the person buying it has to look at his financing costs, etc., and say, is this worthwhile? So does a buyer look at a business when they're trying to buy it? There's a number of things. The biggest thing is past performance. Other things that also come into and are of equal value is how easy is this transition going to be? Does this company have policies and procedures in place? What happens the first time, the XYZ machine breaks down, okay? Are there written explanations on how to fix it? How do I get it back online if it's an online tool? Are all the machines in here in this building common use machines where I can go to a manufacturer and get replacement parts? Or did the owner build these things himself or herself, and he's the only one who knows how they work? If that's the case, I've been involved in selling machinery and equipment. There's little value to a machine, okay, that it was made up by taking parts of 10 other machines or an individual who built it on their own. Without a lot of details, you can't fix that machine. Your financial records, how clean are they? I mean, does your year-end statement tie into your tax return? Come across many clients where you look at their year-end statement and their tax returns and they're far afield. Their balance sheets don't tie in. Okay, the retained earnings don't make sense. Okay, what industry are you in? Is this the right industry I should be in right now? Okay, if you were trying to sell an airline right now, not a good place to be. You're trying to sell a hotel, not a good place to be. All right, the customer mix, once again, when I mentioned any one customer is more than 20% of your business, that could be an issue. The next thing is free cash flow. How much money flows from this business? Is it generating free cash, and how much? Employees and management. How old are the employees in this company? Are they going to be around for a while? Are they interested in staying? Okay, what are the hard assets of the business? What value do they have? Is there a building involved? What kind of maintenance is done? Has there been a lot of deferred maintenance that went on? Right now I'm talking about manufacturing operations. The thing may also be true in online business or a service industry. What about the software? If somebody was going to try and buy one of our government services, the IRS is still working on software that was put in 1962. Is your business operating that way? I had a client who was using software from the 1950s. Okay, they were still just shy of putting cards into the thing to keep the computer going. That takes away from the value of a business. Let's go to the next one. Okay, the next thing is closing and negotiations. One thing you have to think about is you often people need someone to help them through this process. That could be an attorney, could be an accountant, could be a business advisor. Unless you've been through this process a number of times, you're often a little uncomfortable the first time through. But some of the things you want to understand is, what are your terms of sale? Okay, terms of sale are price, terms and condition. Price is the one you look at last. Okay, terms and conditions are the most important parts of the terms of sale. The next thing is, what does the buyer need? The buyer probably needs a company that generates positive cash, that generates enough so he can go to a bank in order to get a loan. If they can't, then they may need the seller to finance the purchase until such time as the business starts generating enough positive cash and they can go to a bank. That's why typically we look at owner finance businesses with a 3 to 5 year balloon, because at the end of 3 to 5 years, if the business is going to go forward, it's generating enough cash that they can then go to a bank and get a loan and buy out the seller. And what are the needs of the seller? Does the seller need cash up front at closing? Can they live with 10% of the value of the business up front? And are they willing to finance the business? So these things have to be looked at when you're thinking about it. These are part of your negotiation and closing process. Next slide. Terms of sales, okay? The details should be listed by the buyer in a letter of intent, okay? And that letter of intent would talk about when they want to buy it, under what circumstances, how much money they put down, what their financing arrangements are, etc. Okay, and what they would expect from the seller. And then the seller has an opportunity to go back and give a counter proposal on this. The next thing is, if you have multiple offers, then it's even more important to have letters of intent so that the seller can look at the various ones and say which ones make the most sense. Because the highest selling price, once again, is not the best, always the best offer. If somebody's willing to give you $1 today, okay, and take the business over, but somebody else says, okay, I'll give you $1.50, okay, but I'm going to pay you over a year or 5 years, you have to decide which one makes more sense. The next one is, okay, you want to look at this. This is particularly where you look at it with a tax accountant. The way you sell a business, how you classify assets, how you classify the selling price has a big implication on your tax liability, all right? The next thing is, make sure you're clear on what your objectives are, both personally and financially, in this transaction. Know what your limits are. If you're asking $1, you have to know that you're willing to go to 85 cents, but not a penny lower, all right? If they're saying, we want you to finance this, and you're not willing to finance it, then you have to know that up front. Okay, you can't make this up on the fly. Okay, you got to do this to keep it going. And remember one thing, negotiation requires compromise. Just to get political for a second, that's why our country's not working very well right now, because the word negotiation is a dirty word in any congressional circle. You have to be able to compromise if you want to go forward. The next thing is the needs of the buyer. What does a buyer need? They need cash flow, positive. They need a going concern with an established infrastructure that works, all right? The next thing they need is a strong financial conditions when they go to the bank. They need a broad base of customers, that 20% rule, and they want to transition without any surprises. They don't want to get there and find out half the equipment doesn't work. Okay. The needs of the seller. If the seller, okay, is going to finance it, you have to do due diligence on the buyer. Okay, you want to know, okay, what their financial condition is. Are they going to be able to pay you and keep this business afloat so that you can get your money back? And if they can't, then this deal may not be worthwhile. Okay, that's pretty much a quick overview. Took more time than I was planning on, but we've got time for questions, and I've got time here if you want to continue after this. Any questions? I'll turn it back to you, Diane.
Great. Thanks, Andrew. That was a lot of very helpful and concise information. So thank you for that. Yeah, we'd love to take questions if anybody has any. I don't have any in my chat box, but if anybody would like to ask any, we're happy for you to unmute yourself and ask, or you can send it to me in the chat and I can ask Andrew.
If not, you've got our information here. You can always contact us after this, or if you should go back and look at the video. So we're more than happy to accommodate that.
Yes. Awesome. And also, you have all the contact information for all the partners who can help you as well. If you have other questions, or if you guys have other suggestions for topics that you'd like for us to cover, we can also address that. So, all right. Well, Andrew, I don't think there's any questions. I think that this is something that we will be able to continue to share with folks, and it will be cataloged in our log of webinars we've been doing. So thank you.
You're very welcome. Thank you.
All right. Well, you guys have a great afternoon. Thanks for joining us. And again, next week, we're going to be doing managing cash flow and why it is so important. So join us again for another wonderful topic and presented by Andrew. So thank you all, and have a good afternoon. See you soon.